So this one here is going to be a recording on discount bonds. And as you can see here, discounted bonds or discount bonds are determined based on the differences between the contract rate and the market rate. Now, for discounted bonds, the contract rate must be lower than the market rate in order for it to be classified as a discount. So when it comes to the par bonds, in the previous video, just to provide a little summary on that, par bonds are bonds that have a contract rate that's equivalent to the market rate. So it's straightforward. But discounted bonds, it differs. And so there's going to be some extra accounting that needs to be done in order to properly record this in an organization's general journal. Okay, so now what does this whole differences mean? The contract rate and the market rate. So why is it that a contract rate, if it's lower than the market rate, why is it labeled as a discount? And why is there a difference? Okay, so I want to first explain the why. Why is there a difference? So the reason why there's a difference between the contract rate and the market rate is because the market rate is determined by the market. It's determined by buyers and sellers. It's just determined by the market. Contract rate is not determined by the market. It's determined by the issuer. So the issuer of the bond can display 2% as the contract or coupon or stated rate. They can say 5%. They can say 10%. That's solely determined by the issuer. But the market is going to be another thing. All right. So since the bond is issued at a discount, the market rate, that lets you know that the market rate and the contract rate are going to differ. All right. And the contract rate is going to be lower than the market rate in order for it to be classified as a discounted bond. So also when it comes to these different rates, this is letting you know that this is a level of risk that the lender is willing to take. That's why there's a difference there. The lender cares about the market. The contract rate, that's okay, but the lender really cares about the market. That's the end all. So it's just like cash. So if you generate revenue of $100,000, but the cash that you are expecting to receive out of that $100,000 is a lot lower than that amount, then you're going to have to make an adjustment to your books when it comes to your revenue amount, because your revenue is effectively it is overstated, which isn't good. You're going to have to make an adjustment because it needs to be aligned to the cash amount that you are expected to receive from the revenue that you generated. Similar to bonds. Bonds need to match up to the market value because the market is the fair market value. So no matter what rate is stated on that bond, eventually you want to line up with the market. So the bond's market rate of interest is the rate that the borrowers are willing to pay and the lenders are willing to accept for a bond at its risk level. So it's like a borrower-lender agreement there. So the higher the risk on the bond, the market rate increases to compensate bond purchasers. So keep that in mind. So contract rate, if it's lower, market rate is going to, help the lenders out. Okay. So what I want to do is actually just provide an example here or a scenario. So we're going to say that a bond was issued on January 1st. This is the issuance date. And the bond had a face value of $100,000. Okay, this is the face value. And it was issued at 97. Okay, what does that mean? 97. 97 means that the bond of $100,000 was issued at 97% of that amount, which means that 97% of $100,000 is the cash amount that the issuer of the bond is going to receive from the lender. That lets you know right here of 97, that lets you know that this bond is issued at a discount. If it's 99, 98, 97, 96, 95, etc., of $100,000 or of a face value amount, that lets you know it's issued at a discount. If it's higher than 99, so if it's or higher than 100, so if it's 101, so if $100,000 face value issued at 101, 102, 103, that lets you know that the bond was not issued at a discount. Okay. Now, we're going to say that the bond reached maturity in 10 years. So this is the maturity here. And we're going to say that 6% is paid semi-annually. Semi-annually. Okay, one thing to note here. When it comes to this percentage is displayed on the bond on an annual basis. Annual percentage. That's what I'm going to put on here. Annual percentage. But this 6% is paid semi-annually, which means that you're going to have to break this down by 2. So take the 6% divided by 2. That's going to give you 3%. And the payments that are made semi-annually is made on June 30th. And December 31st. Okay. First thing we'll need to do. Let me zoom out so we can see all of the facts. We're going to have to first record the issuance of the bond. Okay. So recording the issues of the bond. So I'm going to put on here the date. The date is going to be January 1st. Account DR for debit, CR for credit. All right. So zooming out here a little bit more. So we provided the issuance date of the bond. Now we're going to go ahead and plug into the general journal. So $100,000 is the face value, but it was issued at 97, which is 97% of $100,000. Again, this means that 97% of $100,000 is going to be received in cash. So we're going to take 97% of 100K. That's going to give us 97,000, and that $97,000 is going to be debited to cash because that's the cash amount that was received by the lender. Next, I'm gonna go ahead and record the why. Why did we receive cash of 97,000? Well, the why was because a bond was issued. So since a bond was issued, we're gonna go ahead and credit bonds payable for the face value amount that's displayed on the bond of 100,000. Okay. That's the face value. That was what was displayed on the bond. Now you notice there's a difference here, and that difference is going to be $3,000, so 100K minus 97K, and that difference is going to be debited to an account called discount on bonds payable. Discount on bonds payable, and it's going to be for $3,000. Okay, this discount on bonds payable is a contra liability account. Okay, which is directly connected to the main account, which is bonds payable. So when you take bonds payable of 100,000, subtract out the discount on bonds payable of 3,000, that's going to give you 97,000, which is the carrying amount on bonds payable. So that carrying amount of 97,000, which is the net amount, that matches the cash amount of 97,000 that was received. Okay, number 2. We're going to now record the semi-annual interest payment and amortization. Let me put it over here, amortization. So before we do that, we have to do some math. I know we have to do some math because we have to do some calculations on the interest, figure out what that's going to be. So before we even record an entry, that's what we have to do, figure out what the interest is going to be. So we have the face value of $100,000 on the bond. So I'm going to bring that down here, zoom out a little bit, bring it down here. It's going to be $100,000, which is, oops, I'm jumping ahead. I'm putting a percentage here. Thinking of two things at once. $100,000, which is the face value. We're going to multiply it by the percentage here of 6%. So remember, this 6% here is an annual percentage that's displayed on the bond. So we're going to take 6% of 100,000. That's going to give us $6,000. But since we have to make semi-annual payments, we got to take the 6,000 divided by 2. That's going to give you $3,000. Now, you can compute this a different way. You can take $100,000 multiplied by 6%, and you can multiply it by 6 out of 12 or 1/2, whatever works for you. As long as you get to this $3,000, that's what matters. So this $3,000 is going to be the cash amount that's going to be paid semi-annually on the bond. Specifically, it's for interest. Okay. Now we have to figure out the bond interest expense. So this is another thing we got to figure out, because the bond interest expense is going to have a different amount than the cash payment that you see here of $3,000, because that's going to show you that the market rate differs from the contract rate. So first thing we need to do, we need to pretty much take, we need to break down the cash payment amount of $3,000 semi-annually, and we got to figure out how much of that is going to be in total for the 10 years of the bond. So we're going to take $3,000 multiplied by 20 payments. Okay, 20 payments, that's your 10 years. Oops, 10 years. Okay, that's years multiplied by 2. So you're making 20 payments within 10 years, so twice a year. That's going to give you $60,000. So that's your total cash payment right there. Payments of $60,000 for 10 years. And you're going to take this $60,000 because, again, we need to figure out what our bond interest expense is going to be in total. We're going to take our $60,000 and we're going to add the discount of $3,000. Okay, our discount here that we recorded of $3,000. We're going to add that. Okay, that's going to give us $63,000, which is going to be our total bond interest expense. Okay. And to figure out what the bond interest expense needs to be recorded on a semi-annual basis, we're going to take this $63,000 and we're going to divide it by 20 periods, or just 20, because that's the number of interest periods, right? Number of payments that are made within 10 years or in a 10-year time frame. That's going to give us $3,150. So that's our interest expense here that we're going to be recording on a semi-annual basis. Okay, so let's go ahead and now put together the journal entry for this long computation here. So for number 2, we're going to go ahead and record the semi-annual interest. I think I just wrote this twice now. Semi-interest payment and amortization. Once we record this for June 30th, it's going to be the same for December 31st. So let's go ahead and put together this journal entry. So date, account, DR for debit, CR for credit. You tell my hand hurts because of how I'm writing. So for the date here, it's going to be June 30th. Okay, so first thing we need to do, well, we need to display the account that needs to be debited, and that's going to be bond interest expense. And it's going to be debited for this $3,150. The account that's going to be credited is going to be cash of $3,000. And that comes from, let me zoom out, or actually zoom in. That's coming from the $100,000, the face value of the bond, multiplied by the 6%. That's your contract rate. All right. That gives you $6,000, which is the annual amount, divided by 2. That gives you $3,000. That's your cash payment that's made semi-annually on the interest. Okay. Now, just like the issuance of the bond, there's a difference here because it's taking into consideration the discount. So since there's a difference here of $150, that $150 is going to be credited to discount on bonds payable, because the bonds payable, discount on bonds payable that you initially recorded as a debit. Okay, if I can zoom in here, it's going kind of slow. On January 1st, it needs to be amortized because you are taking into consideration the contract rate, which is the cash payment of $3,000 that's being made. Okay, let me now come back down here. And that's taking the face value, multiplying it by the contract rate, and then multiplying it further by, or dividing it by 2 to get $3,000. And you're taking the interest rate into consideration, which is going to be higher than the cash payment that's being made. Okay, so that's your compensation there that the lender is getting. So the difference of $150 is going to be credited again to discount on bonds payable, and this is when you are amortizing the discount on bonds payable. You're amortizing that account. So this is what you're doing. You're amortizing it, which means amortizing the account, which means that you're just writing down the account as the cash payments are made, which is made towards interest. And yes, again, there's a difference there. I know I'm repeating myself, but there's a reason for that. The difference comes from the contract rate versus the actual market rate. And on December 31st, you will make this same exact entry